Retail traders stare at naked price candles and get chopped to pieces by noise. Institutional algorithms ignore the candles. They track momentum and time. Staring at a raw price chart and trying to guess where support will hold is a mathematical disadvantage. It leaves you constantly vulnerable to random volatility and perfectly engineered stop hunts. The computers managing massive institutional capital do not draw subjective diagonal trend lines. They execute based on strict volume profiling and specific momentum shifts. To trade alongside that capital, you have to track the actual underlying rhythm of those algorithms. You have to monitor the mathematical breathing cycle of the market. This is a comparison between the retail approach and the institutional framework. On the left, a chaotic chart filled with subjective trend lines. On the right, a clean chart displaying only horizontal initial balance lines and a deeply smoothed momentum histogram. Shifting from emotional chart reading to strict rules-based momentum tracking is how you escape algorithmic liquidity traps. We map this rhythm using the DRW ABC Wave Framework. It is a mechanical sequence that translates algorithmic buying and selling into a clear visual engine. Look at this smoothed MACD histogram crossing the zero line from negative to positive. This is the A wave, or the action. It marks the exact initial impulse where algorithmic momentum steps on the gas and shifts the bias. Immediately after the impulse comes the pullback. Here, the momentum bars decay back toward the zero line, shifting to a dark blue state. This is the B wave, or the base. The algorithms take their foot off the gas to collect liquidity and trap retail traders. Finally, the exact moment the algorithms step back on the gas to drive price to its final target, the momentum histogram sharply hooks upward. This prints a distinct execution label, a C, right on the zero line. This is the C wave. Tracking this specific three-part sequence prevents you from chasing a massive run at the absolute top, and it gives you concrete, mathematical proof of exactly when a pullback has ended. The math behind the A wave is precise. It fires the microsecond the MACD histogram crosses the zero line, specifically when the price is stretched to a logical extreme, like a daily quant support level. There is one non-negotiable rule when applying this system. You never execute a trade on the A wave. The initial surge that causes the A wave is rarely broad institutional buying. It is usually driven by algorithms covering their short positions to take profits, combined with aggressive, high-risk traders trying to catch a falling knife. This graph illustrates what happens next. The unproven momentum surge creates a temporary price push, a dead cat bounce. Almost immediately, the price snaps violently downward, breaking below the original starting point. Market makers actively engineer this false breakout. They push the price just over key resistance lines. These markers show the cluster of retail buy orders triggered at the peak, all of which are instantly wiped out by the downward reversal. The A wave is the lightning flash telling you a storm is coming. It is strictly an early warning radar of exhaustion, never a green light for capital deployment. You do not enter on the pullback either. The B wave is a strict mathematical filtration system. It is an interrogation room used to determine if a pullback is a safe refuel or a systemic liquidation. The first filter is volume interrogation. This chart tracks a price pullback alongside its corresponding volume footprint. Here, the volume drops more than 25% below its established baseline, a mathematical condition known as ghost volume. Ghost volume proves that retail traders are the only ones shorting the pullback. The institutions are completely absent. As this label indicates, this creates a perfect trap for sellers and a highly safe refuel zone for buyers. Conversely, if the pullback volume spikes more than 50%, only then can you confirm it is a controlled liquidity sweep rather than a genuine trend reversal. Even if a pullback passes the volume and depth filters, it introduces a temporal danger. Waiting too long for an extended consolidation to resolve will result in theta decay eroding your options premium. To counter this, we apply the wait time rule. A standard institutional B-wave pullback takes exactly 3 to 4 candles on its dominant timeframe to complete the liquidity trap. To translate this across charts, we use the 5x visual rule. One 15-minute candle equals 5 3-minute candles. If the 15-minute chart is pulling back, you must wait for 15 to 20 candles of chop on your 3-minute chart. Applying strict mathematical timelines to a pullback eliminates the emotional impulse to jump the gun before the algorithms have actually finished accumulating their positions. The exact execution trigger is the standard C wave. It occurs the microsecond the micromomentum mathematically hooks off the zero line, resuming the direction of the primary trend. While a standard hook can provide a solid basehead, it is still vulnerable to low-volume retail noise. To scale up position sizing, you need undeniable proof of an institutional footprint. This is where the framework applies an advanced mathematical filter known as the true C. A true C requires 3 simultaneous variables. As shown here, the momentum histogram hooks upward at the exact same time a candlestick physically expands in size, while the volume bar simultaneously breaks upward through a 20-period moving average line. When these 3 signals align, the engine illuminates a gold C indicator. It provides undeniable mathematical proof that big banks are participating in the breakout, making it the highest probability execution switch in the entire system. Beyond the standard breathing cycle, institutional algorithms actively engineer specific, highly precise mathematical anomalies that are designed purely to exploit basic human psychology. One of the most aggressive is the zero-line kiss. The momentum histogram bleeds downward in a deep pullback until it perfectly rests on the zero-axis line without ever crossing it. By holding the zero line at the last possible microsecond, the algorithms spring a trap. Retail breakout traders assume the trend is dead and begin shorting. The histogram then violently spikes upward, fueled entirely by the stop losses of everyone trying to front-run the reversal. The exact opposite scenario is the truncated B wave. Instead of a deep bleed, the pullback only lasts for 1 or 2 candles before instantly hooking back into a C wave. A truncated wave indicates extreme institutional urgency. The algorithms are in a panic to accumulate. They sweep the ask at market price and refuse to wait for a discount. Recognizing these mathematical anomalies is the dividing line between generic chart reading and identifying actual algorithmic desperation. Markets possess algorithmic memory. The institutions remember the exact origin zones where massive capital was deployed during previous true C waves. To map this memory, locate a historical volume spike. Draw a horizontal zone around its origin, extending it right to create an institutional fortress. Weeks later, as price slowly bleeds on low volume, it drifts down to touch the top boundary of this historical box. This structural defense becomes explosive when combined with multi-timeframe alignment, specifically the fractal nest. This occurs when your macro 60-minute chart and your micro 5-minute chart fire a true C hook at the exact same millisecond. When a fractal nest fires at the exact moment the price tags an institutional fortress, the resulting algorithmic defense is violent. The institutions that built the original wall deploy massive limit orders to prevent their accumulation zone from breaking. Combining the macro ocean tide with a historical structural defense creates a mathematically optimized setup, generating the highest possible conviction for trade execution. In the fully realized DRW system, every component has a strict job. The A wave issues the warning, the B wave interrogates the volume, the true C wave executes the strike. Succeeding against automated capital requires abandoning subjective trendlines. You have to track the actual momentum logic and volume footprints left behind by the algorithms. Let the horizontal structural lines on your chart dictate exactly where you want to do business, and let the mathematical wave logic dictate exactly when to pull the trigger.